This ETF has a very interesting future. First off, read this disclaimer carefully. We will go to the basic materials and specifically look at battery metals and materials ETF. It's from Amplify. BATT is the ticker. Some decent gains from the 52-week low. Still some distance from the 52-week highs. Let's first look at the seasonality. Okay, so you can see that we do not have that many years, hence the data here is it's something you need to take with a grain of salt, but you can see that there are certainly some months that are stronger than others. Let's first explore a bit what this ETF is about, okay? So, Advanced Battery. BATT is a professionally managed ETF that seeks to provide exposure to lithium, cobalt, nickel, manganese, and graphite via publicly traded stocks. Companies in the portfolio are principally engaged in the business of mining, exploration, production, development, processing, or recycling of advanced battery metals and materials. This ETF is very interesting due to the major push we have towards electric cars and cordless electricity and energy more broadly. Hence, you could make a pretty strong long-term case for this ETF. There are pure lithium ETFs. The nice about this one is that it is more diversified. You can see here that you get the primary exposure here is lithium, but it is balanced. That's great. That's some flexibility that the ETF managers have. Let's look at the charts. Here's the entire history we have of this ETF. As you can see, it has actually been in a pretty significant downtrend and getting a real push down here during the shutdown due to the contagion. We have seen a very substantial bounce from the lows. We are above some key resistance levels, but you could certainly make a case that, the bears, they are in charge in the sense that we do have, see that this high here, the recovery high, it didn't even get up to these lower resistance levels. Hence, looking purely at the current picture, you could certainly, say the bears are in charge. They just are. For the bears not to be in charge, we would have to get above the 50-week moving average in green and use it as a support level, because 1-2 times we have gotten above it but have a failed breakout. In those two instances, you see the same pattern. One candlestick closing above, then we slip. One above, we slip. So that's a key level to watch out for. RSI is in the neutral zone. The accumulation distribution line does not show any massive influx of buyers, unfortunately. 56. Let's save. Yeah, so that's a bit unfortunate. However, looking long term, if you have a horizon of multiple years, then I wouldn't mind nibbling a bit on this ETF. I mean, you could make a pretty strong case that this is the future. At least these kinds of metals will become very popular in the... well, they are increasing in popularity, but they will increase more. You could certainly make that case. The reason why the chart looks the way it does is also because many investors, they have a much shorter time horizon. They're looking at, the next quarter. Hence, what is reflected in the current price level is basically what people think is going to happen soon. That gives the long-term investor all kinds of opportunities. And this is one of the reasons why the long-term investors substantially outperform the shorter-term traders, on average. Let's go to the daily data points. You can see that here we get a correlation with S&P 500. 93% positive correlation. That is pretty strong. Very strong, actually. One of the challenges with especially if you look at electric cars, is that they are often priced with a premium above their fossil fuel competitors, which means that you could make a case that they are more discretionary. However, many governments around the world are strongly incentivizing people to go for environmentally friendly vehicles, which are offsetting some of those costs. Looking at the daily data points, yes, it is basically about the red 200-day moving average. Get above, fail, get above, fail. Hence, you want to see us not only get above the 200-day moving average, you want to see us use it as support. Unfortunately, you see that here we are actually stronger than we are here. Here we get up to the 200-day and we are like petrified and we freak out and we sell off. And we don't even use the 20-day moving average here as support. Because that would be more ideal. If you get a bit freaked out, then you use the 20-day, test, you get the squeeze effect, and then you can have a breakout. But currently the bulls are timid and weak. Long term though, I am bullish, but I want to see, a little bit more strength. At least, because the thing is that the 200-day is negative, hence we will just by a force of nature, we will see it cross below price action eventually. And at that point, the bulls have less and less excuse for not being able to use it as support, at least. Yeah, so that's the moving average to watch. Also, of course, finding support at the 50 or the 20-day would also be okay, as long as we can be above the 200-day moving average. So those are like the levels I would want to just watch out for. Okay. The sector we are looking at in this video is called basic materials, and it is one of the major sectors in the market. And you might ask yourself, what is it? And this is something that many of you will probably be surprised at what actually constitutes basic materials. Okay, so think about what you think it is, and now you will see the truth. Agriculture, that's one example. So fertilizers, seeds, and pesticides, those are a few examples. Building materials, like clay, bricks, paint, you get the picture, concrete. Chemicals, you have adhesives, you get acids, explosives, all kinds of specialty and, more general chemicals. Coal. Forest products, you have lumber, paper, pulp, metals, and mining. Here's a more substantial list. So you got aluminum, you got copper, gold, silver, uranium, you got tin, you got nickel, you got titanium, you name it. So that's a pretty substantial list. There is a specific metals and mining ETF called XME. And then you have steel. Let's explore this ETF a bit more. Let's go to ETF Database. I used to use ETF.com, but it has just really deteriorated as of late. Unfortunately. Expense ratios is on the higher end of the spectrum, but then again, this is hyper specialized and you don't really have many alternatives. This is what happens when you don't have competition. They are using the opportunity to hike the expense ratio. Okay, well, let's maybe look at the dividend and valuation. So you got a PE here of 14-ish, not too bad. What is this? And what is this? I think SLX is steel, if I'm not yeah, it's steel. I'm starting to get a pretty good grip on the tickers. I have looked at so many tickers over the years. This one has a very high PE. I have never heard about this one before. US Global Go Gold and Precious Metal Miners ETF. Yeah. Okay. If you want dividend, this is actually pretty decent. Almost 4% dividend. That's good. That is a good dividend. Pick. That one has, a bit. That's the global metals and mining producers. approaching 5%, but 4% dividend, that's pretty darn decent. SLJ, that's the silver junior miners. Yes. Okay. Yeah, let's explore a bit further. Expense ratios. Yeah, BATT is has the highest expense ratio. FMAT, what is that? Yeah, not the same. You can see some of the holdings. So molybdenum, a lot of fancy. You know, some of these materials are also in the more rare earth category. Here you can see some fund flows. Not a lot of data going on here. ESG. So the ESG score is 4.5 out of 10. Yeah, not a big surprise. I mean, the metals and the mining companies, they do struggle with the ESG score, but that's just how it is. If you look here at fact sheets, maybe real-time rating, technicals. Yeah. Well, actually, look, exploring a bit more detail here. Here you can see the sector breakdown. Not a big surprise to see a massive part of basic materials. Market cap breakdown, you got some nice diversification here. Regional breakdown, also relatively diversified. All in all, I think this is a very interesting ETF. Here we got some additional data. No options available, not a big surprise because the liquidity is a bit limited. You can short it. Okay. So to sum up my take here on this ETF, currently it is pretty clear that the bears, they do have a pretty strong hand. They have recently done some damage after the comeback. We do have some key moving averages that I highlighted that, you know, is to put on your radar. But if I were to say like, okay, long term, okay, if you have like a multiple year time horizon, you know, you are getting this at one of the lower prices. You know, it's much better to buy here than over here. Obviously, I find it a bit difficult to make like a very bearish long-term case for this ETF. I mean, I would like to hear your bearish case in the comment section if you have it, but I don't see it. I see you know, there's so many forces that will benefit this ETF and these kinds of companies, but they are longer term. Okay, that was this ETF. Let's look at the US 500, the S&P 500 futures. Okay, here you can see that we did have a massive recovery day yesterday. We slipped all the way back here to the 50-day moving average, found surgical support, then we get above. Today we are trying to break out above the 5-day moving average. But we are currently in this consolidation mode, but there is a clear bearish bias here. I had a theory recently by some researchers, which was actually very interesting, but also, you know, a bit problematic for many people, and that is that there is good reason to think that because of this massive distortion of the market, we could spend multiple years going forward in this massive consolidation range. It might take a long time for the market to actually figure the heck out what happened here. That could lead to all kinds of rallies, pullbacks. So the market could just be shell-shocked for years. The problem with that is that investing, you know, in the indexes, it's not going to work anymore. It just isn't. Hence, we could definitively be heading towards a stock picker market and sector picker market and industry picker market. So that's something to really keep your eye on if we do see that trend developing. Okay, let's look a bit at some seasonality here towards the end of the video. So let's look at XLB. That's the Materials Select Sector Spider ETF. Because I looked at it yesterday and I saw some very beautiful seasonality here. You can see, okay, this is all the data we have. Well, it's you know, between this period, 20 years, and you can see that there's a very clear rise, declining cycle. That doesn't mean that it will always work out, but it certainly seems like August has historically been a very good month to buy the XLB. let's just run through some other ETFs while we have some time here. Let's look at, as an example, let's look at XLF then, the financial select sector. Then we go all the way back here. Here we can see some seasonality. June is very weak, but that also means that June could be actually a decent month historically to buy the XLF, because July, right around the corner, it's one of the stronger months. That's interesting. Let's what other ETFs should we look at? Yeah, let's look at Energy XLE, the Energy Select Spider ETF. Here, okay, we are in June, so July is one of the stronger months, but you do have the problem that August is actually one of the weaker months, so it's sort of like you have a bit of a, it's sort of stuck in the mud. Okay, so maybe, yeah, let's stop the video. Okay, whatever you do, of course, don't fight the trend, and may the trend be with you.